Okay, welcome back, traders. It's Friday, February the 16th, recording this about 7:35 Eastern Time. A wild week in the market, lots of ups and downs, and plenty to talk about. So as a reminder, this is a Rain King recording for educational purposes. So I thought we would talk a little bit about the big picture to step back and see where we are in the super cycle concept. Then we'll go over the indices, the internals, and then we'll go back to focusing on the leaders. What are the leaders doing? And then we'll have a summary. So the big picture super cycle. It's been a while since I've talked about this, but the concept of the market goes through secular bull market cycles. And I'm just showing here a real long-term chart from the 1940s through today. And you can see that, from 1937 to 49, it was a 25-year secular bull. And then we also had a secular bull from 1982 to 2000 to the dot-com era top. And the major low that was put in 2009 really was the beginning of the next secular bull market super cycle. So we'll talk a little bit why that is the premise. And the question is, if it is a super cycle, do we have a 25, 26-year window, which could take us out to 2035? So looking at bull market super cycles, this is the 1974 using the S&P 74 through 2000. Now in 1974 was a devastating bear market. We made a low and then we kind of ground our way higher over a 10-year period. But the demographics were really the next driver that were going to kick the secular bull into overdrive. The baby boomers entered their peak consumption years in the early 80s, 83, 84, 85. And they were going to be doing a lot of buying of houses and cars and generating wealth in the economy. And you can see from the 82 follow-through day, we had a real nice bull market, had the 87 crash, which slowed it down, but then it continued to move higher through the bear market of 1990. And then in 1995, with the birth of the internet, things went into real growth mode for the economy. And it was a stellar 5 years, taking us to the 2000 top. Real strong super cycle was 26 years. So going back and focusing now on the more recent cycle that I believe we're still in, this started in 2009. 2009 was a devastating great financial crisis low. And then there was a period about 10 years where we were grinding our way higher. And we actually made about 350% gains over a 10-year period up until around 2018. And most people said the market can't possibly go any higher. It's been going higher for almost 10 years. And the demographics supported the market going higher. There were 84 million millennials that were entering their peak consumption years starting in 2018. And it wasn't until 2021 that the oldest millennials were turning 40. They're really in their prime years for generating income and their spending. So even though there's going to be bear markets along the way, we just came out of this 2022 bear market, the millennials are a powerful force demographically. They're going to be, for the next 10 to 12 years, they could be generating a lot of consumption of cars and houses, insurance products, financial services. In addition to the baby boomers are retiring. So they are transferring their wealth. They have second homes, they're transferring their wealth to the millennials. So it's a lot of powerful things lining up that support a strong growth, not to mention all the technological advances coming up with AI, which could be said to be paralleling the growth of the internet. So that's the super cycle that I believe we're in. This is a long-term view chart of the NASDAQ composite from 2000 through today. And it's a monthly chart. And I've shown this chart many times over the last 3 to 4 years. I bring it up every 6 months or so. But the long-term trend lines are still in place. Got a trend line along the lows, got a trend line along some of these highs. And even the bear markets we had, COVID, we got some support along the lows of these trend lines. And the bear market I have been saying during the entire bear market that this 10,000 to 11,000 area in the NASDAQ could be an area of support and support that we were still in the super cycle. So it held right in that area, and we've turned back up, challenging new highs. So the premise, I believe, is still in play, and the future does look bright, I think, for the next 5 to 10 years. Now, with that said, if we come back to the short term, we're in February. And February is usually not a great month seasonality for the markets. Now, Carson Research here has put together a table that shows that really the trouble comes in the second half of February. First half is, kind of sideways to a little bit of a bias upward. But you can see from the 15th to the 29th, generally its seasonality is down. So, could we expect to be pulling back? Well, seasonality says that we might pull in a little bit, but we'll take it day by day. So let's look at some of the indices as we get back into more of the current market. This is the S&P 500 on a weekly chart, weekly candles. Now I'm zoomed out to the weekly because during the week, if you look at daily charts or intraday charts, there was a lot of wild action. But with the close today on Friday, we look at the charts and we say, where are we? And on a weekly chart, you can say this rally, the first leg up was 9 weeks up, and then we had 1 week down. And then we've had leg two, which I've talked about what our expectations could be, has been 5 weeks up and 1 week down this week. So it's still very, very constructive. We're above the 50-day moving average. I've talked about the $5,000 level as being a psychological pause possibly for the S&P. Even a pullback right now of 4% would bring us right into the 50-day, which would be normal. We have also gotten back to new highs, even though the market has been very volatile on Tuesday and even today with the PPI, we still have seen net new highs. So that's still constructive. Now, at 5,000, there's a couple things that could happen. We might just pull back a little bit, pause a little bit, catch our breath, and then maybe make the next push higher in this bull market, leg number 3. That would be a good scenario. But it's also possible that we have a deeper decline. Maybe we have more of a decline that comes down 8 to 10%, similar to what we saw from July through October of last year. So we might have more of a grinding decline. Or who knows, maybe we blast through next week and continue to go higher. So we have to be open and flexible to each scenario. Now, there certainly is some froth in the market saying we need to pause a little bit. I put out a tweet yesterday on Super Micro, and I basically said, I'm going to call it. I think there's so many signs that this is a climax top. The tweet got an incredible number of views. It was like 23,000 views. Some people agreeing with me, some people saying I was nuts. I didn't put the tweet out because I was predicting anything. What I put the tweet out for was, if you follow the rules of a climax top, Super Micro had all the characteristics of a climax top using rules, not emotion. There's a lot of people that have made a lot of money on this, and I'm really happy people have caught this trend. I was not in the stock. I was positioned in ARM instead and did well with that. But when you look at all the rules, it looked like a climax top. Now today, most of you are probably aware, Super Micro came down 20%. It opened higher and reversed very, very hard. 20% drop on its largest ever volume in its history. That's really typical of a climax top that kind of seals the deal. And particularly, I was concerned about this 1,000 price level. So again, it's not about being right or wrong. I encourage you to go to How to Make Money in Stocks. Look at page 263, has all the climax rules. Climaxes are tough because you're making so much money so fast that you get greedy. And it's an emotion, it's a very strong emotion, and you don't want to give up that stock that's been so good to you. But if you follow the rules, you'll be able to nail down that gain and capture all of what you've earned. If you get really, really greedy, this can happen and you've lost a number of your gains. So there is some froth in the market, supports maybe we would come back in a little bit. So this is the percentage above the 50-day moving average. This is still not a great picture. The Nasdaq is on the left. We've, excuse me, we've come down. You know, we're starting to come out of this a little bit, but then we got hit on Tuesday, and then we came back strong on Wednesday and Thursday, and we took a little bit of a hit today. Now the S&P has been more of a grind lower. You know, these charts are not the most appetizing, so it's still some mixed signals under the hood that would support the market pulling in for a pullback or maybe something deeper. Now, on the positive side, the Russell 2000 has started to show some real signs of life. You know, the market came down last week, and this is actually a weekly chart, a couple of weeks, but it did get support at the 50-day, which was key. And then even this chop that we've had the last couple of weeks, you can see generally getting support at the 50-day moving average. And we've just started to rally, and we're coming right up against this long-term resistance. If we can get a breakout in small caps, that really could bring some more buyers into the market, supporting more risk on, and maybe it supports the next leg. Not saying that's going to happen on Tuesday with the holiday, but maybe we doodle around a little bit and then we launch. That would be very positive for the market, showing an improvement in breadth, getting down to the small caps and the mid caps. So let's look at the action of the leaders. It's always important to keep your tabs on all of the leading stocks. So I've used this table that I've been showing every couple of weeks. So I did this last night. The Nasdaq was about 1.2% off its highs, and we could expect growth stocks to be 2 to 3 times that, which would mean 2.5 to 3.5%. So I've really tried to line up in blue. These are the ones that are acting so well. Look at all these stocks. This is after we had the shock on the scary day on Tuesday with the CPI. Most of those stocks have rebounded very well within 1 to 2 days. And there was definitely some resistance today with the PPI. But in general, look at the AD rating of these stocks, A's and B pluses. They're barely off their highs. And when you look at the distribution in these leading stocks, hardly any. Very constructive. The relative strength lines are pointing at 1 o'clock, 2 o'clock. Many are at new highs. This is very, very positive. Now, there is another segment of the leaders that are starting to deteriorate. You can see here, Square, Fresh, even ARM, which had done really well, but it's still 18% off its ultimate high. But we've got some problems with some of these stocks here. You can see the distribution ratings are C's and D's. Maybe they just need to base out and rebuild themselves. But it was really encouraging to see the action on Wednesday and Thursday in the leading stocks. If anything, if some of that was algo driven on Tuesday, certainly a number of the institutions looked at it and said, we're buying. We want to keep accumulating stock in the leading growth stocks because they know that whether it's 3 months from now, 6 months from now, or 9 months from now, rate cuts are coming, which support growth stocks. Now, we have had some scary drops, and I just put the COVID bear market recovery on the left and our current market on the right. The wall of worries, bull markets climb this wall of worry. There are going to be bad, scary days along the way. Look at during COVID, we had a 3.25% drop. We had a 3% drop. These were very scary. I recall these. And here's a 5% drop. But yet, what you know about this is these drops immediately turned around and were supported at the 20-day moving average on that rally. So what's happening in our market? We've had some bad days. We had a 1.6 drop. We had a 1.8% drop. We had a 3% intraday drop a couple of weeks ago, and we were down 2.5% on Tuesday. But you'll notice we still are holding some key moving averages. We're generally holding the 20-day. We undercut a little bit here, but we rebounded very, very quickly. So even, this is still a good picture, though on the counter side, today is our 3rd distribution day on the NASDAQ, and the S&P has 5 distribution days. So again, that evidence is showing us that there is some distribution. The market's not completely breaking down, but I think it supports the market is going to pull in to some degree. And we just need to be positioned and take it day by day. I sent this out a couple days ago. This was my rule. When you have a bad day like Tuesday, my rule is I want to see a 50% recovery of the drop within 1 to 2 days, or it's a bad sign that maybe the stocks are rolling over. And as I mentioned before, some of those leaders I just showed you, all of these names did rebound very, very strongly on Wednesday and Thursday. And it's really the kind of action you call tennis balls. They bounce and get support very, very quickly. So the idea is, when you have these bad days, you have tennis balls that are these short, brief pullbacks that bounce quickly back to new highs, or do we have broken eggs? Broken eggs are when we break support and we don't get any rally at all. We just go splat like a broken egg on the floor. So I've just shown a couple of examples and I'll show you one more. But we want to own tennis balls. And certainly that batch of leading stocks that I showed you with all the green on the table are showing you that they're tennis balls. This is Shopify from March of 2019. Again, came out of a base as we were starting to rally. You can see here, short, brief pullback down to the 20, immediately went back to new highs. Come back down to the 20, starting to push back up. And on a weekly chart, a mini chart here, when you put it in context on the weekly chart, look at the number of weeks up in a row, and then we're 1 week down with a tight close, and then we came right in to the pullback to the 10-week moving average, and it got support. So look for this tennis ball action. It shows you that your stock is still under accumulation and that you have your hands on a leading stock. So the wrap up really is looking at our typical key metrics, the percent decline from the highs. The NASDAQ still near new highs, and that is amid all of the CPI volatility and the PPI, which was kind of expected given what happened on Tuesday. The market is still holding in there. The key levels are still being supported. We're still above the 20-day moving average, and the power trend is still in place. So we want to follow price. Now, the net new highs and new lows, we are still positive. We're in the green. We still have net new highs, and we're still above 50 net new highs. So that's, again, constructive. That's still telling us that there's not a complete breakdown in the market, even though some other breadth measures are questionable. The leading stocks, we mentioned, some of these leaders are acting really, really well after those 2 shock days to the market. These internals, though, are kind of mixed. My gut tells me that we're probably going to digest and pull back a little bit, maybe trying to reset ourselves to build a little bit of a launching pad before we can get another bull leg, be bull leg number 3. But given all of the mixed signals we're getting, I've reduced the exposure levels a bit. I know that I got knocked out on some stops on Tuesday. I got knocked out of 3 or 4 positions that had small gains. Frustrating, but that's what you have to do to protect yourself. I don't know if it's the time to just rush back in and buy more stock. I think you have to be patient here. So I've reduced this to 40 to 60%, which I think is about right for me. If you're more aggressive, then maybe you're a little deeper into the market. But we are seeing some distribution days, and the breadth is still not really giving an all clear. It's not bad, but it's not great. So a little bit of caution here is how I see it right now. So the quote of the week is from Peter Lynch. Far more money has been lost by investors preparing for corrections than has been lost in the corrections themselves. So, we can all try to figure out where the market's going, but it really doesn't matter. We really just want to interpret day by day what's happening. We want to be flexible, and we don't need to predict. So let the market come to you, stay in the moment, and just protect your positions. Make sure you've got your stops in place. And also, when we get good signs of the next leg, we want to be ready to buy more stock. That's the general market update for February 16th. Have a great holiday weekend, everybody. We'll look forward to seeing you next Friday.